To some, the actions of Ben Bernanke and Mario Draghi were exactly what the global economy needed. To others, they've gone way beyond their mandate. This is exactly what Akshay Kapoor from Gekko Global Markets thinks. Big actions by Ben Bernanke and Mario Draghi in recent weeks. Are all our problems now solved?
No, I think our problems just started.
And why do you say that?
I think, as you know, there's a huge debt overhang in the global financial system. There are two large engines of growth: the US on one side, China on the other. Both of them are slowing down, albeit for different reasons. Along with that, we have a huge public and private debt overhang, as you know. A lot of deleveraging on private balance sheets has already happened in the US, but that deleveraging is in place in Europe at the moment. So unless we tackle these problems and properly deleverage and clean up private and corporate balance sheets, the engines of growth will always face hurdles. And I know central banks have tried to postpone the problem by very aggressive easing. I mean, infinite QE3, as Mr. Bernanke wants to do. Ultimately, that will lead to a liquidity trap, and I don't believe that will support growth in the long term.
But clearly, the markets don't agree with you, because since the actions by Bernanke and Draghi, we've seen what has been described as a sugar rush and markets looking upwards since those big announcements.
Whenever you ease so aggressively, liquidity floods the system and asset prices go up, and there's no doubt to it. But I speak to a lot of colleagues in fund management, in hedge funds, and I think most of them know what the situation is. But the fact is that till such time that the sugar keeps flowing, people are going to keep gorging on it, which is fine. But I think people are aware that there is a stage when the reckoning will come and asset markets will collapse. It's just that it's probably been pushed away for another year or so.
But isn't it the case that the central banks are aware that these measures are just a stopgap, that they have to step in the short term, and in the medium and long term, private companies can step in and fill that hole?
Private companies will step in and fill that hole only when there's an increase in productivity. Would you agree?
Surely the case is that things aren't growing at the moment.
Sure.
So the central banks have to do something. They have to do something. For example, the Fed's mandate is to help with the employment situation in the US, and they can't sit back and do nothing.
I think, yeah, sure. The Fed's mandate is basically, you make a very good point. Just stepping away from the Fed a little bit, the Bank of England's mandate is an explicit inflation mandate, right? The Fed does not have an explicit inflation mandate. Their mandate is more implicit. So their mandate is a combination of inflation targeting as well as growth. So I completely agree that if there is overcapacity and if demand stimulation can increase growth, we must do everything for demand stimulation. However, I don't believe that is the fundamental problem. I don't believe there's significant overcapacity. I think the problem is a debt overhang. And the debt overhang will only go away once we go through the painful process of readjustment.
Well, that's not the last you'll hear from Akshay Kapoor from Gekko Global Markets. Next time, he'll be given his investment tips in this difficult global environment. But for now, goodbye.